If I asked you right now, what type of risk environment are we in? You probably answer pretty quickly. You look that we are on the S&P 500, you look at this uptrend, and you think, well, it's risk on. US equities are going up, so it's risk on. It's a positive type of risk sentiment. Perfect. Now let me switch that up. US equities are going down. You probably say, well, it's risk off. All clear. But here's the uncomfortable part. If I then asked you why, say you probably understand labels. You understand the definition of risk on, and you understand the definition of risk off. But you don't understand what's actually driving the market underneath. And that difference is everything. Because markets are never just risk on or risk off. They're reacting to specific fears, specific pressures, and specific expectations. And if you don't know which one is in control, which context is in control, you're missing a very important ingredient for your trades. The market can be risk off because it's scared of a recession, of inflation troubles, which could be leading to the Fed over-tightening, so trying to slow down the economy, or because of tense geopolitics. All these situations, they look similar on the surface, but they trade completely different on the chart. So in this video, I'm going to show you how to build a very simple dashboard using just 4 markets and how the relationship tells you exactly which type of risk environment we're in. That makes the whole difference because every context calls for a different type of flow, a different type of movement across currencies, across risk assets like the S&P 500, the Nasdaq, across gold, metals, commodities. So let me show you. So first of all, we need context. Context is the difference between a gamble and a trade, a professional trade. To get context, in this case, we're going to build this simple dashboard. So it's the US 10-year yield, it's the S&P 500, it's gold, and it's the dollar against the Japanese yen. See, the point of all this is that institutions are not asking, is the market risk on or risk off? Okay, they're asking, what is the dominant narrative right now? Why is the market moving right now? Because the truth is that not all risk on or risk off are the same. So the answer to that is this dashboard right here. 4 charts, same time frame. Now this is about context. These 4 assets together tells us exactly in what type of risk sentiment environment we're in. Now, obviously, we can understand that by understanding the context, but some traders want to see things on the chart. So this dashboard will allow you to do that. And that's extremely useful because a lot of traders end up getting stuck in a wrong trade because they were trading against the environment. They were trading against the macro flow, so to speak. So let me walk you through it so you can understand what I'm talking about. Now, the first asset on the list is the US 10-year yield. This is where most traders I know start to get bored because most people obviously think that yields are boring. The bond market is boring. Well, I want you to wake up from that thinking because bonds are actually the most important market of all. Everything revolves around yield. Yields are basically the market whispering to itself about growth, about inflation, about what the Fed is going to do next. So when yields are rising, that's the market saying, okay, growth is okay, inflation probably might go up, growth maybe is doing pretty good, and policy, monetary policy, as a result of that, might need to stay tight. That's when yields are going up. When yields are going down, that's the market saying something is wrong. The economy is slowing down a little bit. Now, the degree in which the yields go down, if they go down pretty fast, that's pretty concerning. Probably a recession, the data is weakening pretty fast. But if they're just going down a little bit, it's nothing too concerning, but it's the market pricing less growth ahead. So all this to say that yields are the thinking part of the market. That said, let's look at the S&P 500 now. This one's obviously easy. This is confidence. This is leverage. This is people saying, I'm comfortable taking risk right now. I want return, okay? When equities are up, there's obviously risk appetite. When equities are down, risk tolerance is shrinking a little bit. It's getting a little bit more defensive. But this is where most people would stop, okay? They understand risk on, risk off, equities up, equities down. But there's a caveat. You cannot just look at the S&P 500 and say, okay, stocks are up, so it's risk on. I see traders getting this wrong way too many times. And that's why I'm teaching you about this dashboard, because the complete picture is when we know what all these four are doing. Now, let me show you gold. Gold obviously doesn't need any explanation. It's a safe haven. But more so, it's a risks are rising type of safe haven, okay? Whether that's fiscal risks, geopolitical risks, economic risks, gold is simply the safe haven, period. And then there's the dollar against the Japanese yen. This pair in currencies and in everything is way more important than people realize. USDJPY reflects carry trades. The carry represents risk appetite all at once. And it's, if you think about it, it's safe haven, the dollar against another safe haven, the Japanese yen. So when the dollar against the Japanese yen is trending higher, that usually means that risk is being tolerated and traders are looking for carry. They're looking for return, okay? They're looking for interest, passive interest. When USDJPY falls aggressively, that's risks being pulled back. That's carry trades unwinding. That's a sign of market stress. It means that traders and investors are getting more defensive. That said, here's where we click everything together. To understand what type of sentiment we're into, we don't look at these markets individually. We look at what they're doing together. So I'm going to show you 4 specific risks environments. 2 of them, you probably know them. And the other 2 is where I see traders getting confused a lot of the time. Let's say, for example, yields are rising. Okay, we're looking at the 10-year yield. At the same time, equities are also rising, the S&P 500. The dollar against the Japanese yen is also rising, and gold is pretty much flat, doing nothing. This is classic positive growth expectations type of risk on. Growth is fine, inflation is manageable, the Federal Reserve isn't a threat, they're not trying to stop growth too much. This is a positive risk-on type of sentiment. So what is the market thinking here? It's what we call the goldilocks type of scenario, which has nothing to do with gold, but it's called goldilocks. It's positive growth and a Federal Reserve that is not fighting it. So the market sentiment is positive. This is where you look for risk and you look for carry. And so you look to get into risk assets such as equities. In fact, they trend higher. And you look for carry. So you look for passive interest. So you look for the dollar to do well against the Japanese yen. Or any trade essentially that pays you positive carry, such as short Swiss franc, Japanese yen. That can also be long emerging market currency, for instance, which often they have quite a good carry because they have 10-15% interest rates sometimes. Now, this is a classic risk-on type of sentiment. Yields up, equities up, dollar against the Japanese yen up, AUD/JPY up, CAD Swiss franc up, and gold doing pretty much nothing. Now let's flip this. Yields are falling, equities are falling off, USDJPY is dropping, and gold. This is where it gets interesting. Gold is the only one up. What does this tell you? Something is happening. Most likely, this is geopolitical risk off. So there's most likely some geopolitical tensions going on. Maybe a conflict heating up. Maybe some threats between countries. Whatever it is, you know something's going on because you're seeing everything down, but gold, the safe haven up. And by the way, when we're talking about geopolitical risk off, picking an eye on oil here is pretty useful. If oil is going up, then you know there's certainly some geopolitical tensions with a country in a region where oil gets moved around, but there's supply of oil, whether that's the Middle East, Russia, or whatever. That's when investors don't care about interest rates. They don't care about carry in that moment. They care about safety. Okay, they care about safe haven, the Japanese yen, gold, bonds. If yields go down, bonds go up. And so they pile into those safe havens. Now, if you see this combo, yields down, gold up, most likely there's some geopolitical activity going on. That said, the one I'm going to get to in a second, is the type of risk off that confuses people the most. I want you to focus here because You're looking at the screen and the S&P 500 is falling. So if you don't know what I'm about to show you, naturally your brain would think risk off, equities down, I gotta go buy gold. So you look at gold, but it's falling too. How so? Gold is a safe haven. If we are risk off, gold should go up. It shouldn't go down. See, this is a very different type of risk off. Yields are rising. This is the key. I'm going to show you why in a second. And the dollar against the Japanese yen is going up. So we got equities falling, gold falling, yields up, and the dollar against the Japanese yen up. This is not recession fear here. Look at what the yields are doing. This is a hawkish Federal Reserve type of risk off. It's when the Federal Reserve pumps the brake into the economy by tightening interest rates to lower inflation. This, obviously, if you've been trading for a bit, this was in 2022. The Federal Reserve was hiking 50 basis points, even 75 basis points at a time. And simply in this environment, the dollar is king. And the dollar against low yielding currencies in particular is king. While everything else, equities, gold, commodities in general, oil also is down usually, commodities down. So if the market is crashing, because let's say crash, obviously the market is just trending lower because the Federal Reserve is raising rates, so yields are up. Gold, in this case, yes, it's risk off. It's a risk off type of sentiment, but it's not a geopolitical risk off. It's not a recession risk off. So gold goes down because the interest rates are going up. Understand what I'm going? This is very important to understand because, most traders will see equities falling off and think risk off. Rightfully so. They're right. But they try to long gold into an hawkish risk off type of sentiment without realizing that it's the type of sentiment that it's actually bearish for the precious metal because rates are rising. And so this is the dashboard in this case that tells you exactly what's going on. Yields are up. Equities are down. It's a hawkish risk-off type of sentiment. And then occasionally, very rarely, you will see something even more particular. Yields are rising, equities are falling, USDJPY is falling, and gold is rising. This is stagflation sentiment. That's the market realizing that growth is slowing, but inflation at the same time is rising. And so the Fed is boxed in. They have a dual mandate. They have to support the labor market, essentially growth, and lower inflation. But if growth is slowing down, so if the labor market is weakening and inflation is rising, they're boxed in. So it's a very rare environment. But this is the type where you want to absolutely pile into gold. We saw a little bit of this in mid-2025 when the US labor market started cracking a little bit while inflation was still near 3%. Now, with all this said, every market trend falls into one of these four buckets. If you can understand and identify, but most importantly, understand the bucket, so understand exactly what's going on to evaluate whether it should continue or not, then at that point, you own the trend. And by the way, you probably noticed there's only one risk on against three risk-off sentiments. Well, I went more into the details of the various risk-off environments and kept it simple with the risk-on because honestly, although there are different types of risk-on contexts, there's geopolitical de-escalation, there's positive growth expectations, there's fiscal boost, there's many different types, but after all, they mostly all produce the same type of flow. Higher equities, so higher Nasdaq, higher S&P 500 and such, and lower dollar, lower safe havens against currencies like the Australian dollar, the New Zealand dollar, and the Canadian dollar. That's pretty much all risk-on type of sentiments. That said, what you gotta do now? You gotta set up a watch list on TradingView, US 10-year yield, S&P 500, gold, dollar against the Japanese yen. And so when you want to have an inside view into what type of sentiment the market is trading on, look at these four and remember the relationship with each other. Is it goldilocks type of sentiment? Is it geopolitical risk off? Is it hawkish risk off? Is it stagflation fear? To read the mind of the market, you must listen to the conversation that's happening between the assets. This dashboard lets you understand why price is moving in real time, the sentiment behind the flows.